Hello, everyone, and welcome to TradeFinder Live. My name is Zach, and we're going to get started here with Rob Roy in just a moment. However, before we do, I'd like to draw your attention to our disclosure disclaimer agreement. If you've attended any of our live sessions previously, then you've seen this. The main thing to take away from it is that we are not licensed investment advisors in the United States, so nothing is to be taken as personal investment advice. You can read this full disclosure on our website at ewotrader.com, or certainly feel free to take a screenshot of it if you like, but that's the main point to take away. All right, so it's about time to hop into the good stuff here with Rob. Rob, I know you saw that testimony from Chairman Powell against Congress that rocked the markets, so very interested to hear your thoughts on that, as well as your general presentation for the night, and looking forward to interacting with you all. So thank you for joining us, and we'll get into the good stuff starting now.
Thanks, Zach. Welcome, everybody, to this week's TradeFinder Live. And Zach, you know me too well. When there's anything to do with the Federal Reserve, you know I'm going to have some opinions on it, and today is no different. In fact, I'm just going to go ahead and start with that, lead with the Federal Reserve stuff, and then we'll come back and look at the charts. In fact, last night I sent out a message, a commentary to all of our. Can you see my screen?
No, we can't. We're still on my disclaimer at the moment.
Okay. There we go. How about now?
Good to go.
Okay. So here's a note that I posted last night to our subscribers at ewotrader.com. And it's talking about we haven't been sending out as many alerts as normal because of where the market is. We'll go through all that. What I wanted to get to was the second part of it, where back in 1978, during the Carter administration, there was something passed called the Humphrey-Hawkins Act. And in there, it required, and I put that in the quotation marks because Congress can't really require the Federal Reserve to do anything. The Federal Reserve is completely independent, but it is best that they work together, and they're aware of that. So the language makes people feel better. But anyway, it asked the chairman of the Federal Reserve to testify in front of Congress twice a year on the state of the economy and monetary policy. That legislation expired back in 2000, but out of the goodness of their heart, the Federal Reserve has agreed to continue with these 2 times a year testimonies. And so my comment was, we're going to be probably in for a volatile day. Everything that Chairman Powell says is going to be dissected 9 million times. And so there could be some whipsawing throughout the day. So that was the note that I posted to our subscribers to make them aware of what may happen in today's trade. And boy, that was pretty spot on, I think. Here's the VIX. And so talking about whipsawing, there was whipsawing even in the VIX. You can see the moves to the upside and the downside. But when we start looking at the markets, here's a couple charts of the market itself. Over here on the left-hand side was early in the trading day. So right up till 10 o'clock, when Chairman Powell started speaking, you can see the market was doing nothing. And then as soon as he started talking, bam, to the downside. There's your whipsaw back up, then back down, then back up, and moving around. And then as we move over into that chart on the right-hand side, you can see it into the later part of the day where we went down. There was a few moves back and forth. There was a rally attempt. There you can see just before 1 o'clock, about 12:30, that was quickly sold into. So it was a day that you just wanted to watch what was going on and not really be participating, especially if you're a shorter term trader. So this is exactly what happened. And just to really top it off, I can show you a chart of Chairman Powell's actual comments that he was making. Here, I'll bring it over to you. This gives you an idea of what was going on. Can you see that? So this is live news of the SPY, and you can see, well, every couple minutes. So I was saying, all with the back and forth, Congress asking him questions, all this stuff, Powell, and that's what was going on. The headlines, usually you don't see anywhere near this number of posts on the live news on the SPY, but anything Powell said got posted. It seemed like any kind of comment that he made. And so that ended up being the whipsawing and the volatility for the day. And then if you saw the final part of the comment, it's like, let's see if this pattern holds. What I was talking about is when we take a look at the market, you can see that we had this wave 4 come down to the 52% level, right at a 50%. We opened here back on the 2nd of March and just barely took out the low. So it moved it from a 50% correction to 52%. So still call it a 50% correction. And in the last couple of trading days, we were trying to mount something to the upside. We sold off into the afternoon yesterday, and I felt like that was because of the testimony of Powell before Congress. And so that's an extended version of Powell's, like he gave his press conference after the FOMC reports that whether they're going to raise rates, et cetera. And so all this stuff going on here, and then kind of said, all right, let's pause a bit. We had actually gotten on the high yesterday, just a tiny bit away from the 10-day moving average, and we were set up for some sort of a move back to the downside. But you can see this move lower here is a pretty ugly bar. So we open at the high of the day, close at the low of the day, close below the 10, 30, and 50-day moving averages. So I think you could say that technically the pattern is held, but that's not what you want to see. Even a little bit of a pullback to the 50-day moving average, I don't think would have been too bad. To see it close below the 50-day moving average on this well above average volume, I think that's where the concern comes in with the move today. So I still think we have to see if we can get back above that 50-day moving average tomorrow. If so, perhaps it's no harm, no foul. But with that kind of volume, not a big spike, but above average volume, opening on the high, closing on the low, breaking below all the 3 major moving averages that I look at. The only thing that's positive out of this day that I can see is that we didn't break the wave 4 low. So that's why I say technically the pattern is still in place, but this is not the price action that you're looking for if we are expecting the market to continue higher. Still, I guess, on the positive side, but this is longer term, not just today's positive. We still have all of these zigzags and the wave 5 still intact. We didn't take out that wave 4 low. And so there's that 100% extension on the C wave of the big zigzag. And then where we look at the complex C wave here inside that C wave of the bigger zigzag, again, 2 zigzag patterns with the exact same price target, and it's the exact same price as where the wave 5 forecast is in the tap box, the wave 5 projection. Tap box stands for time and price projection for those of you that are new viewing with us. So that is pretty impressive. Until we break this wave 4, I'm still not ready to just toss in the bullish case scenario here. The pattern is still technically intact. That's impressive to see. And I talked about this before. Every now and then you can see a couple patterns that are roughly the same target price, but they have 3 different Elliott wave patterns with the exact same target price. That doesn't happen very often. So we have to give that the benefit of the doubt, in my opinion. Now, if we come down, we break this wave 4 low, we come down and take out the 61.8% potential wave 4 correction, which still technically would keep the wave 5 pattern intact. It would probably damage those zigzag patterns. And then we have all this support here at 380. So the Elliott wave pattern aside, there's a lot of support there at 380. So you could even stretch it to say, I'm not totally ready to throw in the towel on a potential upside until we break below 380. So you can see that there's some confusion on where we could go from here. I think that a lot of that is alleviated if we rebound and get back above the 50-day moving average in tomorrow's trade. No follow through to this break below the major moving averages. And it's like, okay, it was an ugly day on Tuesday, and we're back in business here with the potential to move back to the upside. One of the things that the market is going to have to wrestle with is now the Fed Fund futures are pricing in a 50 basis point rate hike in this meeting, in the March meeting, where it was at 25 points. And then remember, the Fed Fund futures was trying to price in when this 50 basis points of rate cuts was going to come in. Originally, it was going to be by the end of the year. Then after the economic data of a week ago, it got pushed out into the beginning of the year. But now if we go to 50 basis points of a rate hike in March, probably another 25 in April, it pushes that potential for rate cuts out further. And Chairman Powell in his comments didn't feel like they were raising rates too far. Now, whether he believes that or not, who knows? But in his testimony, he said he doesn't feel like they've gone too far in raising rates. And so that prompted the Fed Fund futures to, it had been waffling on 25 versus 50 at the March meeting, but now it's a solid expectation of a 50 basis point rate hike at the March meeting. So that does push everything a little further out. Does that push it far enough out to disqualify this Elliott wave pattern? In my mind, that's the question that we need to, all these other things that I've been sharing with you, they're all talking points, but the question that needs to be answered is, does that disqualify this pattern? Do we push it out so far that we have to correct further, even correcting below 380 to where we really start all over again with a new impulse pattern? I would hate to see that, because this is so well formed. I mean, when you're looking at this pattern, this is a really well-formed 5-wave pattern. It's classic in nature. I've shown you the zigzags that are included within this. It's about as good as it gets from an Elliott wave standpoint. So I would hate to see this one become disqualified, but anything's possible. Even the best Elliott wave pattern is not 100% guaranteed. Nothing is 100% in trading. No technical indicator has 100% accuracy, and Elliott wave is not 100% either. But when you have a well-constructed pattern, the percentages are pretty high, but it's not 100%. So it doesn't mean that it can't become disqualified just because it's a really good setup now. So tomorrow's trade, what we're watching for is, can we close back above this 50-day moving average? That's what I'm going to be looking for. If so, then we have some upside trades ready to go. But it has to show us that first. It has to do it. And if not, if we get follow through to the downside, then we're going to be on pause, because we don't have enough information to put on short trades yet with this pattern still qualified. Breaking this wave 4 low and heading towards 380. If there was enough time, we could do something really quick, because if we do take out this wave 4 low, high likelihood we're going to come down and test 380. So I think there could be a quick short-term downward trade there, at least till we move down to 380. But we have to break that wave 4 low first. So again, tomorrow, all eyes to me. Can we get back above the 50-day moving average? Back above 400 on the close would be more ideal. But I don't know. You know, it's just a little bit of time, and it's just 25 more basis points of rate hikes. Can the market discount that and still stay bullish to the upside? It's going to be really interesting to see. So I look forward to seeing what happens in tomorrow's trade, but nothing that happened today surprised me at all. Absolutely nothing. Even closing below the 50-day moving average with the action throughout the day. But boy, that whipsaw action, that especially in that first chart that I showed you, which was in the first 2 hours, and then it was more kind of whipsawing on its way down to the low of the day towards the end. But in the early part, there was some rally attempts, some significant rally attempts that got reversed right away. But that big initial move down was pretty crazy. All right, so let's take a look at rates and see what rates are doing. Interestingly enough, rates didn't take off with what Chairman Powell said today. So we just closed back below that 4% level. We had broken above it. You can see with that gap, we came back down, kind of leaving that one bar out there on an island, but no Elliott wave pattern that's been labeled yet, because remember that we finished the wave 5, went back to the previous 4. That whole scenario, wave 5 pattern ends, you retrace back to the previous 4, all that happened exactly as it was supposed to. So once that's been solidified, the algorithm is now trying to say, where's the next impulse move? What comes next? And I think we could all probably agree that that's some sort of an impulse, but what is it an impulse of? Is it a new 5-wave pattern? Is it the A wave of a flat? Is it the A wave of a zigzag? We don't know. So we have to wait for the corrective move before we can figure out where we're going with this next pattern. So interesting to me that we didn't have a big move in interest rates today with what Chairman Powell said. You could view that as a bullish sign because interest rates taking off to the upside would certainly not be bullish for the market. But then we take a look at the dollar, which has been cooperating really well. If you've heard any of my webinars recently, I've been commending the dollar for hanging in there and acting well. Well, now look what we have. Now we have a 5-wave to the downside pattern, and that's because we had gone back, and the previous pattern, remember, was where that 3 was a wave 5 low, and this was the previous 4. I'll walk it back to where you can see it here. So lost the dollar here. Let me get the dollar back for us. Anyway, so it finished. I was just going to show you that it finished this pattern. It retraced. It did exactly what it was supposed to do. And so then we start looking for where is the next Elliott wave pattern. So there's the chart of the dollar again. And we are now in a wave 5 to the downside pattern. But if we just walk it back, see, there's what I was talking about, how we had that wave 5 low. You retrace back to the previous 4. That's what happened today. So whereas with the TNX, the 10-year, algorithm hasn't identified a new pattern yet, but with the dollar, immediately once that previous wave 4 was achieved, it labeled into a 5-wave to the downside pattern. So it feels like the dollar may go lower from here. Now that could be viewed as a real positive for the market, especially with tech stocks, internationally based companies or companies with a lot of international exposure. If that does indeed happen and the dollar starts down, look where it is. If you've been listening to any of the broadcasts that I've been doing, 96 is the line in the sand for me with the dollar. As long as the dollar stays above 96, I think it's a real positive, other than we don't want to go way up here. That's too strong of a dollar. Now, if we were to break below this wave 5 forecasted target, then I would start to get concerned that maybe the dollar's getting too weak. And why? Why is that happening? That could be substantial weakness. I mean, it would have to be really substantial weakness forecast in the US market for the dollar to crash that far. So obviously that's not a positive. So I wouldn't want to see that. But if indeed we do start to get the dollar to move lower and we get TNX to come correct somehow in whatever kind of pattern that we have going here, those are two positives for the potential of this 5-wave target and those zigzags to hold. So you can see we're precariously close to where the bullish scenario goes away, but the case is still there. It still exists in the patterns, still exists in what the 10-year is doing, and still potentially exists in what the dollar is doing, although today wasn't. So that was the dollar. And one last note here on the dollar, right at the 38.2% fib corrective level, which means that could hold and we could start lower in the dollar. So, it's just a little bit for everybody, I think, in the market right now. But I also think that giving a couple more days before placing directional trades is the prudent thing to do at this point. Whether you're bullish or whether you're bearish, either direction, I think it's prudent to let's just observe the market for. There's never anything wrong with just having observation days and not forcing trades or putting things on just for the sake of it. Let's see if we can get a clearer picture. Nothing's ever 100% anyway, but we like to have as many percentages in our favor as we can if we're going to be placing trades. So why not hang in there a couple more days and let's see how this plays out? And I think that's prudent, prudent and very smart at this point in time. So really interesting there. All right, so looking at some of our past case study considerations, and if you're new to TradeFinder, what we do is we talk the markets as we're doing Actually, I'm going to show you some more international markets before we look at those. But we do also look for case study considerations, and we have a few that could be considered open that we've identified in previous trade finders. So we'll take a look at those, and then we'll take a look and see if we can find one for tonight. The difference with TradeFinder is we look for considerations, and then you're on your own. At ewotrader.com, if you're wondering what I showed you the note that I posted to our subscribers. Our alert subscribers get alerts sent out for entries, any adjustments, and exits. So we kind of walk them through the process of opening a position to closing it, rather than just saying, hey, you're on your own. So that's the difference between the alert service and TradeFinder. But let's go ahead and take a look at some of the other markets here, and then we'll take a quick look at, there's a couple I think you're going to find interesting there in the previous case studies. So here is the Dow, the DIA, and fairly similar pattern to the S&P with the wave 4 correction at the 50% level. Also with the diamonds, we had gotten back above 330, which, as you know, even if you haven't been here before, you can just see the chart, how important 330 is from a support resistance level. It's a big deal. And we had kind of gotten above it and then came back down to it. Now, when you take a look at the moving averages, yeah, we closed below all the major moving averages on the DIA, but we held 330, which is important. Can we turn and get back above at least the 10-day moving average tomorrow on the diamond? So some damage done today, but not destruction. Does that make sense? So I think that's kind of where the theme goes on what's going on based on Chairman Powell's testimony in front of Congress. And, it's almost comical to watch how that goes on, where all the congressmen want their 5 minutes of fame, literally, with the Q&A, et cetera. But here we have the Qs, and again, pattern very similar. We noted this last week, where they're all in a wave 5 pattern to the upside, all with very similar wave 4 corrections. It wasn't that long ago. Remember, we were talking about the 3 major moving averages. All 3 had different Elliott wave patterns, and that just doesn't last. And it hasn't lasted. They're all congruent now. They're all very similar. And so when we take a look here, you'd have to say that of the 3, the Qs by far perform the best. That's a positive, because as we come out of this, we've talked about the Qs underperformed on the way down. We were all over that on the way down. And then we've been saying, as we start approaching the end of the rate hike cycle and start looking for rate cuts, the Qs would be the leader coming out of that and moving in towards a rate cut scenario. And that's proven correct as well. Really closed right on the 10-day moving average. So still above the 30 and the 50-day moving averages with that wave 4 right there. So really not an ugly day at all in the Qs. Certainly not as bad as the S&P or the Dow, and less volume, still above average volume. So I mean, I'm being picky here, but not quite as bad, not quite as severe volume on this move to the downside on the Qs. So the Qs chart definitely is the best looking of the 3. So let's take a look at the IWM, and the battle that's been going on with 190. Gosh, we've talked about that so often. We'd gotten back above it again until today. So the previous couple of trading days, we tried to make a break above it, closed back below it yesterday, waiting for this, and then closed below not just 190, but the 50-day moving average here as well on the IWM. But we're hanging in there right around this 190 level. And now we have the exact same. So we have the 4 major moving averages, if you add in the IWM, the Russell, with the exact same 5-wave pattern, all with very similar wave 4 corrections. Is that not meaningful? It seems like it has to be, doesn't it? And I think that as we get more doom and gloom, perhaps that is some fodder for the market to move to the upside. Let's take a look at the VIX while we're talking about volatility and what could happen in the markets. And we did get a little bit of a move to the upside. This is also a fly in the ointment of the upside scenario. We're still at the bottom end of the range. We've been talking about how this may play out where we spend some time at the lower end of the range because we spent so much time in the upper end of the range around 35. So, just the reverse scenario, spending time down here. But it's hard to go significantly higher when the VIX is already down at 18. It would be better if we were talking about, a big spike in the VIX today with that downward move, and we've gotten up to a 23, 24 VIX, something along those lines, where we had some room to the downside. There's a little now, but not much as far as the potential for the VIX to move down as the market moves up. So that's a little bit of a negative thrown in there as well. So looking at some of the markets of choice, if you will, Bitcoin, how's Bitcoin fared with all this stuff going on? Not too well. Yesterday, we had this triangle. We talked about that last week. Specifically, we talked about it in our insiders meeting last Thursday night, how well formed this triangle was here on Bitcoin. And if you're long Bitcoin, that was not the direction of the breakout that you wanted to see. So we broke to the downside, but no follow through here, which is interesting. But it does seem challenging for Bitcoin to go much higher without at least coming down now to test 20,000 again. So it got up to 24, tried to make a run above it, tried to see if we could get some momentum to get up to the 28,000 mark. It couldn't do it. It consolidated. That's okay. It can break either direction, as you know, out of a triangle, but it broke to the downside out of the triangle. So I would not be surprised at all to see Bitcoin come down and test 20,000. It doesn't have to, but there's just not a lot to hold it. Maybe there's a little bit of support here around 21,000 that could hold. Other than that, there's just not a whole lot there. Unless we immediately turn around and this becomes a false breakout to the downside. It is possible, because there wasn't a follow-through day to the downside today, that this was a head fake. It was just a false breakout, but it needs to turn around and immediately go back higher if that occurs. And I talked to our subscribers about this a lot, that head fakes occur in the market. That's why it's really important to be patient and wait for that follow through or confirmation day when you break a major moving average, break out of a triangle, break above support resistance, any of those things. When you make a significant move, one day doesn't matter. It has to have that second day, the follow through or confirmation day. Otherwise, these head fakes just suck people in, and then they take it away from them the very next day. You may have experienced that some in your own trading. So we're really big believers in wait for that follow through or confirmation day and let that play out and see where things go from there. Let's see how the Aussie market is doing down under, and yikes, we couldn't hold 23. So it certainly appears that 22 is the next stop, and that wave 5 is the high from this impulse pattern. And then we're going to make our move back to the previous 4 and then start again, figure out where things go from there, just as the algorithm is trying to do with the TNX and interest rates. So it tried, gave it a little bounce attempt, couldn't hold it. Breaking below 23 is important. You could look at this and say, well, you just told us the importance of a follow through or confirmation day. It's true. It does need to close lower again tomorrow if we are going to come down to 22. Breaking back above 23 could stop that, but it's got to get back above there. And there you are again, below all the major moving averages on the EWA. So looking a little precarious here for at least to move back down to that previous 4 at 22. And then we see and go from there. Let's see how the EWC Canada is doing. Slightly better in the fact that it's holding that last area that it needs to hold right there at 34. So it held there for a week or so, bounced back up. In fact, last week when we were talking, we're like, gosh, nothing has been going on in the markets really for over a week, 2 weeks. This has been kind of churning. And then they started to break in the last 2 trading days before today to the upside. And then everything was given back today. Just 2 days up, 1 day down. The old adage of the market takes the stairs up and the elevator down. So that's where we are here. But the shining light here is that we haven't broken 34 yet. We can still hold here and maybe try to move back. But with the EWA breaking down, perhaps Canada's not too far behind it. But we'll see. I mean, if the U.S. market can get back above 400 on the SPY and the 50-day moving average, then maybe Canada can hold here and turn and move back to the upside as well. INDA, nice bounce back to the upside in this wave 4, following the wave 3 down to that level at 39, which had support going back to June. So the wave 3, the only question now is, are we continuing in this wave 3 impulse lower, or is this the wave 4? And we need to get higher. It's not labeled the wave 4 yet. So we are still technically in wave 3 to the downside. But we got back above the 10-day moving average. Tried to hold above 40. The break below 40 is suspect. That's a little negative, but here we go with that follow through or confirmation day. Do we break back below 40 again? If so, then probably that wave 3 is not done yet, and we continue lower. To be forming the wave 4 in this bounce, we got to get back above 40 tomorrow in the INDA. That will be crucial for that to play out. Now, you know, the German market has been flexing its muscles on this last run. How's it doing now? After underperforming for so long, probably outperforming the international markets at this last move coming out of October, and pretty impressive here. It did close below the 10-day moving average, but we had gotten a little bit overbought. We're kind of right at it, a little bit below it, still some room above 27 and the 50-day moving average. And then we still have potential support here at the previous 3. So even a move down to 26 doesn't take away the strength of the move to the upside. So in question now, whether that wave 5 is done on the EWG or not. It may not be. We're hanging in there pretty well. And again, up till today, it looked like we were ready to really take a rally back higher, but got thwarted today, but not that significantly compared to the other markets. So I think we could still agree that of the international markets that we've looked at, the EWG is outperforming them. And so it's been a long time coming for fans of trading the German market, for sure. All right, so now let's go back and take a look at some of those previous case study considerations that we looked at. Alphabet, Google, we had looked at that. We got that big move to the downside. We did send out an alert to our alert subscribers for a move to the upside. You can see that the 5-wave pattern has gone away, but our line in the sand to stay long was 90, which it's held and looked really good going into today's move. So we were pretty much back to the entry point. But today, moving down with the market, it was trying to hang in there early in the trading day, but it just the selling pressure is so consistent going into the close that it just couldn't do it, and did finish a little bit lower, but not that significantly. So still above the 10-day moving average in Google. So outperforming the rest of the market, if you will. The Qs did. So Google's hanging in there. I think that still looks pretty good. And then we looked at Apple on the same day there, and taking a look at that move. Pretty much, if we go back and look at the entry point at 154, and today we close at 151, but look where the high was yesterday, 156. So we had moved above the entry point yesterday. And if you're wondering what happened with this gap up, Goldman Sachs upgraded Apple. So that's why we had the big gap up yesterday. And so, you know, it carries a lot of weight when Goldman Sachs says something. So that moved it up. So you could argue that really a constructive day for Apple. All we did was fill the gap that was created yesterday, which you need to do, or we like to do. I am a believer. Gaps get filled. We never know when, sometimes immediately, sometimes it takes time. I like it when they get filled immediately, because then you don't have to worry about, all right, when's it going to reverse and go down and fill that gap? That's always in the back of your mind and always a concern when you have a gap that doesn't get filled immediately. So that's a positive. Also, as with Google, above the 10-day moving average. So looks pretty good there on both of those. So, you know, the big guys, and there was some commentary on the financial networks today talking about, gosh, this reminds us of FANG days, where the 4 stocks are doing all the heavy lifting. And it is kind of reminiscent of that with what's been going on over the past few days. So does that continue, or does the market rally broaden? You know, it's going to be, again, interesting to see how that all plays out. And then on the 14th of February, we looked at MPWR, monolithic power systems. and with all this stuff still kind of hanging in there, filled this gap here a couple days ago, on the 1st of March. And so hanging in this wave 3 to the upside, close right on top of the 10-day moving average. Don't see any reason to change any point of view on that. Could very well turn and move back to the upside in some sort of a decent tape on the market. Now on Southwest, we said if there was follow through there, then we were going to trade this to the downside, and we did get that. So it got a little bit of a bounce, but then there was a doji there on the 3rd of March, and then with today's low, we're back near that low around 33. That's going to be the key. Can it hold 33? If not, then it very likely goes back down to 31. There's nothing there to stop it, but it's got to break 33 first. It can still hold 33 and move back to the upside. And so trading below the 10-day moving average, the bearish 1030 cross, the positive on Southwest is 33 is a lot of support, and it could hold. We'll see if that holds or not. And then last week we looked at F5. FFIV is a symbol as a triangle with this potential descending triangle occurring here, a bit of a vertical one for sure, and trying to break to the upside. And we've talked about this. This is a good example. If it holds, this could have a false breakout as well. Triangles sometimes do, but we gapped up there. The breakout was a gap, and we filled the gap today. So perhaps it's just, okay, let's fill that gap real quick, and then we can turn and continue with this upward breakout. That's very possible with moving forward, or it could be a false breakout. We come down, we break below 140, and then it is, I don't know if Zach is busy doing other things or not, but
Katie bar the door.
He would say the magic words of
Katie bar the door.
Yep. If it breaks 140, that is a Katie bar the door to the downside. But for now, it's an upside breakout, not a confirmation though. No confirmation. We just gapped up and came back and filled it. So we'd have to turn around and head back to the upside. So still danger of a head fake here. And this is really good example of why when you put a strangle on, you buy now the money call, you buy now the money put, you don't take one of those off on the initial move. It would have been real easy to say, oh, on this gap up to the upside, let's take the put off and just let the call run. That way we can make more money, because obviously when you're buying a call and buying a put, whatever the direction moves, one of the options is making money, one's losing money. And there is a point where the one's making money so much faster than the other one is losing. But if you can take the losing one off, you're making money even faster. But then you're adding a whole bunch of risk that's not there before. And you get these head fakes where oftentimes you'll get a break one direction, but then the big move is actually the other way. And again, it's just sucking people in, and then the big reversal comes. It may not. It may hold here and continue its upward move. It did close right on the 10-day moving average. So as I said, it could just simply be filling the gap, then we're going to turn and head back higher. Once again, over the next couple of trading days, going to be very interesting to see with what happens with FFIV. So lots of interesting things to talk about tonight. I think everybody would agree. Let's see if we can find a case study for tonight. And I think we're going to kind of try to stay in the strangle area with the fact that markets can move either direction. I mean, the two long positions that I would feel comfortable with right now, we already have Google and Apple. So let's see what we can find. And notice that the consolidating stocks number is up to 119. Those of you that are curious as to what this stock program is, it's called Profit Source. It's developed by a group called Hub, HUBB.com. You go to their website and find out more about it. I think it's the best Elliott Wave software that exists on the market. I've tried all the ones that I know to exist. I don't ever like to say I've tried them all. Maybe there's something out there that I'm not aware of, but the ones that I'm aware of, I've tried, and I've been trading Elliott Wave since 2001. So I have been around a while doing this. And then you see these EWO searches here. Those are my searches. So the subscribers to Evo Trader TradeFinder.com that also have profit source, have the ability to see my searches and what I'm looking at each and every day. So I think that's valuable for our subscribers. So let's take a look at Amazon. Wow, right off the bat, that one jumps out. Let's see what that pattern looks like. Man, we might have found one right away. It isn't the best pattern on the lower trend line, the higher lows, because there's just not that many. I'm going to redraw that. There's not that many touches. The more touches of the trend line, the better. The lower highs is great. There's, you can see that. That looks really good. But this big gap here is not the most ideal of the symmetrical triangle formations. But the ADX is very low. It's below 13. It's down right around 12. And, we've had time to absorb that. I'm just going to go ahead and pick this one right away. It'll give us a couple extra minutes of Q&A. But rather than look through anything else, I mean, we've got potential bullish looks at Google and Apple. So why don't we just add Amazon in there? But on this one, we'll take a look at it from a strangle standpoint and cover both directions. And if the market does decide to go down, easily you could see Amazon go test those lows at 80, and from 95, that would be a really nice move. That would be a nice trade to the downside. So I'm going to write down a strangle for Amazon. And if you're newer to us, we don't do strangles the old-fashioned way where you buy up, call and put one strike out of the money each direction. We go down to the ideal delta as far as acceleration up the delta curve where the best gamma lies, and that's in the 25 to 30 delta. So we set them up a bit different than what you would read if you were just out on the internet looking for information on a strangle. We call them unique. As far as I know, it's a proprietary way of doing it. But once again, the powers that be, a book was written about this. The publisher wanted me to write a book about this strategy. And again, said, you don't know that somebody wasn't doing this 30 years ago that you're not aware of. So be careful using the word proprietary. So we say unique. It's a different way of doing it. I'm not aware of anybody else doing it the way we do. But again, doesn't mean there isn't somebody out there doing it. But nonetheless, it's a way that we like to do strangles to where it gives us the opportunity to make money on a breakout either direction. And we're putting more odds in our favor as far as the speed of the one option making money. So the one option makes money faster. The other option loses money slower. So it gives us the potential to make a gain as fast as mathematically possible. No guarantee we're going to make a gain, but it does guarantee that if the stock breaks out, we will make a gain as fast as mathematically possible. So it still has to move. If it doesn't move, then a strangle, straddle, whatever, are going to lose money, period. There has to be a breakout. All right. So with that, Zach, and I didn't even, draw this all the way up there at the 115. I was just using this more recent area here between 105 and around 80 as the area for the potential breakout. But in a good market, that's not out of the question that we could break above 105 and go back and test that 115 level. So I kind of like that one, except I'm not in love with this gap here, but it's too much of a name stock, so well traded that I think it warrants giving it a look. All right, Zach, I'll turn it back over to you and let's take a few questions here.
Yeah, that sounds great. Thanks for that presentation, Rob, as always. And I just would like to take this moment to remind everyone that if you've enjoyed this webinar so far, don't forget to smash that like button and hit subscribe if you haven't subscribed already. Excuse me. It goes along. Excuse me. Let me take a sip of water here. It goes a long way for us, so we do appreciate it. All right, so we have a number of questions to get through. We're certainly not going to get through all of them. Great time to have a tickle in my throat. We're definitely not going to get through all of them. We never do with the limited time in this session. So if we don't get to your question, just know it has nothing to do with the validity. We just only have so much time as we are live streaming to multiple different platforms. So without further ado, let's get through as many as we can. Rob, you're going to think that I set this up, or as you might have mentioned before, that I was maybe That's the word I'm looking for, trying to bribe our subscribers for their questions, but there's a lot of discussion around NVIDIA. So if we want to start out with that one. And
yeah, I smelled that coming as soon as you started talking. I do think you have your plants in here that are aiding you and asking the question for NVIDIA, knowing that if you see that, it's definitely going to be one of the ones selected. But NVIDIA is
confirm or deny.
Huh?
I said I won't confirm or deny.
I'm just kidding, obviously, but NVIDIA has been extremely impressive. Watching NVIDIA every day, along with Apple, would be one that we would send out if the market does hang in there and doesn't go down to test that wave 4 or look at breaking it on the S&P, talking about this move that we talked earlier in the broadcast. So if we don't head down there, if we can move back above 400, then NVIDIA is certainly on the radar screen. It was really attractive to see that move lower today. If you wanted to be slightly more conservative, you could say, let's let it break above 240 and then go long. But notice how, unlike the rest of the market, et cetera, it is above its 10-day moving average. So it's kind of up there with Google and Apple, outperforming what's going on in the rest of the market, even with what happened in the previous 2 days before today. But it looks awfully strong here. We didn't come down and fill this gap, so that keeps me nervous, as we just described. So I'm not going to reiterate that. But, you can't, if you sit around and wait for the gaps to get filled, you're never going to trade. It's nice when they get filled quickly, but they don't always. And NVIDIA could run 100 points before running out of gas, and someday down the road we come down and fill that gap. 94% of gaps based on data get filled, but that doesn't give you any type of a time stamp on when they're going to get filled. So it's extremely high percentage of gaps do get filled, but when? So that's the caveat that's there. As far as NVIDIA, I think it looks really impressive. Unless the market falls apart, I think this is if you're wanting to be bullish, there's a whole lot worse stocks you could pick than this one. You want to be aggressive, staying above the 10-day moving average, you could do something tomorrow, I think, and be aggressive. If it breaks below the 10-day moving average, then perhaps you pull back and wait and see if this gap is going to get filled, because it could fill the gap even before it gets down to the 50-day moving average. If you want to be slightly more conservative, let it break above 240 first and then get in. There's still plenty of room. The target's up at 280. So you can still have a very nice trade, even if you're a little more patient and wait for the break above 240. You can see it traded above it yesterday, closed near the low of the day, but a lot of stuff did, waiting on Chairman Powell's testimony today. So yeah, NVIDIA looks awfully good. It's hard to find anything negative to say about that stock right now, especially. I guess we could look at the volume real quick, and you can see that it was average volume, but that's well below what was going on in the rest of the market.
All righty. Thanks, Rob. Next up, let's go over to UNG. There's been a lot of movement. Apparently, I still haven't cleared my throat.
Yeah, I figured UNG was going to come up, and I left that one off because I wanted to talk about this. And just when we were making a nice run here, we talked about how UNG looked oversold, making a nice run to the upside. We have an upside.
We lost you for a moment there.
Did you want to say something, or are you just clearing your throat?
I just was saying we lost you there for a second, but I think you're good now.
Okay, you still hear me?
Yep, you're good to go.
Okay. As you can see from the background, I'm up in the mountains, and what timing to come up here. Friday night, there was a tornado, a landslide on the mountain, took out a number of power poles, the internet, everything. So they are trying to rebuild the infrastructure that was damaged Friday night. So picked a great time, but that's the way it goes. But as far as UNG, moving nicely to the upside here, look good, ready to go. A weather report came out, a weather forecast saying that the expectation of temperatures moving forward was 25 degrees higher than what was expected. That's a lot, and that's what sent UNG down. So it was a forecast of warmer temperatures, less need for natural gas for heating, and that's what caused it to move to the downside. Now, we could argue that, man, it's been so beat up already. How much more are we going to beat this up? And that was, part of the fact that, we got this extended wave 5. We had a pretty vertical move lower. It certainly was overextended to the downside. It was bouncing back nicely, exactly as expected, until that weather forecast came out yesterday, and it came out in the middle of the night too. It was like a 2 a.m. thing. If you're watching the futures, straight down. One of those things like what happened in the market today when Powell started talking. And like, what in the world? What happened? What was going on? It was actually creeping to the upside in the after hours of trading until that big move lower. But that's what it was. It was a weather forecast. So now what? Well, now we have to look at, can we hold 8? We may come down and test it. Today was constructive in the fact that we did not take out yesterday's low. We didn't get back above the 10-day moving average, though, so that's a negative. Watch to see if we come up and fill this gap right away, if we can turn and head higher, or is that forecast going to take all the steam out of the oversold bounce that was occurring in UNG? And that's all we were looking for, was an oversold bounce. We're not expecting UNG to take back off to the upside. That was never the plan. It was just to capture an oversold bounce, which looked great up until yesterday. So the analysis here is, can it hold those lows there that it built around 8? There's one of your head fakes here that I was talking about, and we just went through that with the head fake, even though this did get a follow through, but it would just suck people in and then turn and move back to the upside. So the key here is, can it hold 8 and regroup and try to move higher, or is that forecast the death knell for it? That's the key. And I'm going to go ahead and look at USO, Zach. Somebody else may ask about it. I just wanted to show this back above 70. And then what happened today, another news report came out that said that there's going to be more production than expected in oil. A pretty decent number of barrels more production than had been forecast in. And you can see we have a strangle on the USO, and then an expectation for it, or had one expectation for it to break back to the upside. You can see how massive this triangle is. And that looked great too, until that news announcement came out today saying that oil production was going to be higher. So same scenario here. Been fighting for a while. Oil has to get back above 70 USO. Looked like we were ready to go, and then boom, back below we go. No follow through day. Closed right at 70 2 days ago. Yesterday closed above it. Puts all eyes on today, and that news report comes out, and so it moves it back down within the confines of the triangle. Still doesn't mean it can't break out to the upside, but that's what happened today. If you're wondering why did oil kick back, it's just looking like it was ready to go, get above 70 and take off. That's what happened. So a couple of important news events that came out for those energy stocks. I wanted to throw that in. All right, back to you, Zach.
No worries. Yeah. So next up, we'll go with GDX.
Oh, that's good because we covered natural gas, oil. Let's get gold in there too. Good selection here of what to look at. And look what happened here with the miners moving back to the upside here, and then boom, back down. Probably had a lot to do with what happened with the dollar today. The dollar sprinting to the upside like that wasn't big for gold. But if the dollar starts to weaken, then perhaps we can get this to turn around and move back to the upside. So if indeed that wave 5 pattern to the downside holds on the dollar, this could hold here at 27 and turn and move back to the upside. But a break below 27 here, gosh, it technically broke it today, closed at 26.89. That's so close. I wouldn't really count that as a break below 27. I would say that we got to wait and see further. But if it doesn't hold, then we're probably coming down to test these lows around 22. If we don't make it there, we're almost certainly coming down to 23, a whole bunch of support there at 23, as you can see, and nothing in the way from where we are now to 23. So really crucial that GDX holds 27. Needs to get, again, I don't count this as a break of 27. It's too close. But closing back above its 10-day moving average soon would be helpful. What you don't want to see is it close, if you're long, is it close below 27, because it could be a rapid move down to 23, almost like one of those vacuum flush out moves. But it's not there yet. Gosh, Thursday night, we're going to have a lot to talk about in the insiders meeting, Zach, because so many things we're talking about the next day or two are going to matter a lot.
Oh, absolutely. And I'm all for it. It sounds like it's going to be an exciting session. So we got a question.
We have a lot of answers, if nothing else.
Yeah, absolutely. So Nick here says, howdy from India. Got a question for Jeff. There's been a few other questions for Jeff as well. So Jeff's not going to be joining us on TradeFinder, but he will be on Insiders. So we're going to save any questions for Jeff on Thursday for the Insiders meeting. So definitely keep note of your questions. So you'll be able to ask it again with him then on Thursday. But Nick did have a question here for you as well, Rob, on SI. On the grounds of the huge volume spike last week, as well as the incredible amount of juice in those contracts, thinking of a fly or a calendar. Thanks.
Yeah, the negative here is this company is probably done. Nick, good to hear from you, and I hope you're doing well. By the way, miss your weekly voice questions on the insiders meeting. But the problem is their business is gone now. And I don't know where there is a ton of juice. The only thing that I could see is if you wanted to, because it's so low, there's not that much risk to the downside. Trading at 521, it could easily just creep on down to zero and be done. So that's what makes me a little bit nervous about a butterfly, unless you put a wide one on. If you did from like a 1 strike to 10 or something like that. To cover some room to the downside, but they're, really they lost their business. It's hard to imagine them staying solvent and staying in business. So it's just a matter of time of how long before they go to zero. And so that's what makes me nervous there. However, if there is any sort of optimism on, bouncing back to the upside, something short term with protection, more like a calendar or something, could be warranted. I could see your butterfly analogy. I haven't looked at the strikes for very short term. Normally when we're looking at a butterfly, we're looking out three weeks or so to generate a pretty decent return on a butterfly. So what I'm talking about is something very short, like a few days instead of a few weeks, to maybe capture some sort of a spike up, but I just don't know where the catalyst would come from. They don't even really have any assets to speak of. Everybody abandoned them in the crypto world for one of the other crypto firms to come in and buy them out. I just don't see the scenario where they are going to survive, and that makes me really nervous on this. I think you never want to talk about selling naked options, but if anyone was ever going to sell a call option, this would be the scenario for that, with the likelihood that it goes to zero. But that's an extraordinary amount of risk. If indeed some bullish headline came out of the blue, I don't know where it could come from. I looked at this pretty extensively when the news came out. I don't see a path without some sort of a, miracle play here saving this business.
Agreed. I see we're a minute after time. You got time for 2 more maybe?
Yeah, let's do 2 more.
All right. So we have a number of requests here for GTII, but that's an OTC market. So I'm not sure that that's going to be in the system or not. If it's not, we
don't have that
just
one.
have to go on to a different one. Yeah, I wasn't quite sure if that would be there or not. So we have a question here from Angel. Hey Rob, can you opine on the correct level of invert yield curve and whether an earning recession may be more probable versus having mass layoff due to worker shortage? Cheers.
Thanks for the question. And, look at that. It's getting worse. There's the yield curve. And so, there are a lot of layoffs. The Federal Reserve is getting their way. It's not really showing up in the data yet, but it will. I mean, you're hearing about layoffs every single day, in the headlines. So eventually that's going to work its way into the numbers. And so they're winning that battle. But this inversion of the yield curve is startling to me. I saw a friend that got an offer for an 11-month CD at 4.25%. That's amazing because the 10 years below 4. So 11 months. It's you hear all the speculation. My experience has been when everybody starts saying it's different this time because people are making excuses. They're coming up with all kinds of excuses of why things will be okay, even though the yield curve is so inverted and been inverted for so long. It's one of the worst inversions in history. It's one of the longest inversions in history. And all of a sudden it's different this time. I don't buy that. I think we have to be really careful and really cautious. And, I think the market was trying to price in the Fed coming back in to the rescue with cutting rates when things started to look really ugly economically, realizing that they'd overshot the mark. I don't understand this whole thing. I'm going to soapbox just for a second here, but I really don't understand why they felt they've got to bring inflation down so fast. Why couldn't it be gradual? Why do they have to raise so hard, so fast, so often? Just to try to and kill the economy in doing so. And that's what the yield curve is saying is going to happen. Maybe it's different this time, but it's been the most accurate indicator forecasting recessions ever. It's almost a perfect record. So I think we have to be really cautious of bad things to come in the economy. But the market seems to be looking past that. The equities market, at least they were until the last 2 weeks of the Fed starting to cut rates even this year, and pulling, the market from the depths of despair, if you will, or the economy from the depths of despair. And now that's getting pushed further out, which just makes things that much more dangerous. The bond market is very smart. It's a very good indicator. And I do not discount the meaning or the power of the inverted yield curve at all, even though you hear a lot of people saying it's different this time. I don't buy it. Maybe I'll be proven wrong. I've been wrong before, but right now I'm not buying that it's different this time. It concerns me greatly.
All righty. Thanks, Rob. Always enjoy your soapboxes. And
sorry about that. We'll still take it though, even though I rambled on.
Yeah, no, I'm not being sarcastic. I think I'm not alone in that boat. So the last one we'll finish with is Yang. It's from the same subscriber that wanted to see GTII. So be able to substitute that for him.
Yeah, I actually am pretty interested in China. Yeah, I just call it caution on the these multiple ETFs. Due to the fact that the time decay is double because they use futures in order to create that leverage for these 2 and 3 times things. So I think this is pretty interesting, and I think that China's numbers are a little bit better than expected, and it's got to at least create the wave 4 at some point. So if you're looking for a potential breakout and a move to the upside here. The thing with it, when you have these multiples here, these highly leveraged ETFs, you got to get it right in a short period of time. Here's one I'm usually cautious in trying to persuade people to stay away from them because of that, because you can be right and the time decay just chews you up. They're designed to potentially go to zero. That means how they're set up. But if you can get the timing right in a short period of time, there's no question, extra leverage, and you can do well and make a good trade. I actually think you might have a chance on this one. Conservative would be let it get back above the 50-day moving average. aggressive is if you've already had a bullish 1030 cross, you tried to get above the 50-day moving average, you couldn't hold it. I don't know. I think there might be something here on this one. So I want to thank everybody, as always, for joining us, spending some of your valuable time with us. Thank you for all the other social media platforms that you've been viewing on. As Zach said, please hit that like button if you like this. And I hope you have a great rest of your week. Going to be an interesting next couple of trading days. And I hope you enjoyed my Fed soapbox speeches, and I look forward to talking again next week. Have a great rest of your week.